Welcome to Skills to Pay the Bills in today's segment of JustAskFreeman.com. I'm your host, Freeman Owen Jr., and sitting next to me is Carolyn Owen, my co-host, business partner, and my lovely wife. And Carolyn, we've got a lot to discuss today.
Yes, we do.
The Tax Act of 2018 has been passed with sweeping overhaul of the 2015 Bipartisan Budget Act of 2015. Now, we're going to summarize some of the changes and how they affect us, and finally, you will give us, we will discuss rather, some considerations we need to think about with respect to making decisions about our retirement plans.
Okay, Freeman. So we have a lot to talk about in only 30 minutes. So
Exactly.
Let's get started.
All right, let's get started.
Okay. Well, Freeman, what is required minimum distribution, and how's the distribution changed with the 2018 Tax Act?
Well, let me share that with you. Required minimum distribution, a lot of folks refer to it as RMD. Mm-hmm. The Treasury Department demands, or there's a mandate that you must take a certain percentage from your retirement accounts, all of your retirement accounts. Okay. I'll refer to them as qualified accounts like TSPs, 401ks, your thrift savings plans, just to name a few. There is a mandatory percentage each and every year once you reach 70 and a half and at attained age, 71 and so on. So for example, withdrawal amounts at selected ages for age 70 is 3.65, but yet at age 75, 4.37. Let me share this with you too. In the year that you turned 70 and a half, all right, it is mandatory by 12/31 you take a certain percentage from all of your retirement accounts. Okay. But you do have a pass, whereas you can wait until April 1 of the following year. Okay. And then you can take what we call an RMD. Well, what happens, you know what happens when you take two RMDs in the same year? You want to share what happens with that?
Well, if you do, they're both taxed as ordinary income.
Exactly.
And if you wait also, you're penalized. And you pay a penalty. We had an example of an 80-year-old gentleman who came to our office, and for whatever reason, he decided to wait.
Yeah, but not on our watch.
Not on our watch.
What we did when we looked at the statement, and the previous year, he was supposed to take $26,000 from his retirement accounts. Yes. And he decided, he says, no, I don't need the money. Mm-hmm. Well, the Treasury Department IRS sort of surprised him and told him that we're taxing the $26,500 he's supposed to take out. Mm-hmm. So we informed him when we saw the statement. And there was a $13,000 fine. Now, he was taxed on the amount he's supposed to take out, and he got a $13,000 fine. So, folks, you can't make mistakes when it comes to when you're eligible for the RMDs. Please take it. You have to take a withdrawal from all your retirement accounts. Not one, but if you have an employer-sponsored retirement account, Carolyn, if you have an IRA, well, you better take that money out of there by the percentage at attained age by 12/31 of the calendar year.
Okay, well, Freeman, let's talk about some of the Social Security updates with the changes because of the new tax law and possible strategies. In late October 2015, Congress passed the Bipartisan Budget Act, and this controversial and sweeping legislation contains significant changes to Social Security filing options, specifically as pertains to restricted application and file and suspend strategies. Now, Freeman, it seems to me like married and divorce filers are going to see the largest impact. So let's talk about this change.
They do see the largest impact. The file and suspend strategy work very well for married filers as well as divorce filers because you can maximize your Social Security. Let me give you a good example of what would happen. Okay. Let's say one of the spouses, and I'm going to use numbers. Okay. Let's say this spouse, I'm going to use husband and wife. The husband has $2,000 per month in Social Security benefits, right? Okay. And the wife is to receive $1,500 in Social Security benefits. Now, with the file and suspend strategy, the spouse with the lower benefit could get half of the husband's benefit. That's an extra $1,000 per month. Table her own Social Security benefit, and it would increase in 8% increments over a 4-year period up to the last year of eligibility, age 70. Well, that's a 32% increase, or 132% of the full retirement age benefit you would receive. The other thing is, the benefit was for married couples is that the husband could suspend taking the $2,000 a month. His benefit would grow 8% per year from full retirement age 66 to the last year of eligibility, age 70. Well, that's 132% of the full retirement age benefit.
Yes.
Well, when you have two, husband and wife benefit, and then once you reach age 70, and let me mention that, the spousal benefit would cease, and what happened is that you would acquire your own Social Security benefit, where it has grown, again, I emphasize, 132% of your full retirement age. Now, some additional information about that is that this file and suspend strategy was terminated. In other words, if you were born before 1960, before 1960 in 2015, the file and suspend strategy would be applied. You could still utilize that. And then it's been phased out over the last 2 to 3 years.
Okay, so now for those of us that didn't get in on it,
it's too
pretty
late.
much over.
It's pretty well much over.
Okay, now what about the changes to the restricted application as pertains to married and divorced individuals?
Okay. This is where you elect the spousal benefit. Okay. Alrighty. This is a point where you fill out an application, all right, so that you can apply for the spousal benefit, and the spouse, again, is not affected. Okay, I'm sorry. The husband, I'm going to use that example, is not affected when you apply for the spousal benefit, which is 50% of the husband's benefit. Now, the thing about that, Carolyn, is that, again, for filers who are age 60 or older as of the end of 2015, the strategy was available and remained unchanged. But once you turn 62, January 1, 2016, the strategy no longer is available because again, now let me share this with you too.
Okay.
Remember, just a couple of minutes ago, I mentioned the fact that the spouse could suspend taking the benefit for 4 years. Well, the spouse can still do that, the husband rather. The difference being is that the husband can suspend for himself. But if you wish to have this, if the wife wants the spousal benefit, he has to take his full retirement age benefit at age 66. Now, this is called deeming. All right. Okay. Now, a good example is, I want to go back to that example where we were getting $2,000 per month in Social Security benefits for the husband, $1,500 a month for the spouse. And I'm going to apply this age.
Okay.
Full retirement age, the husband is at 66.
Okay.
Can you tell me what happens if she's at 64?
Well, she has to wait until she's 66.
Exactly.
She cannot get it at 64.
That's right. And plus the husband has to start at 66. Yes. By the time she hits full retirement age 66, he's 68. Then, and only then, can she apply for spousal benefits. That is to get and be eligible for half of her husband's benefit, table her own or set aside hers to grow at, or say increase at 8% a year, all right? Okay. And then switch over to her own benefit after reaching age 70. But you can see if at one time we didn't the husband did not have to file for his benefit, but now whoever has the highest benefit, and if they want a spousal benefit, again, that age limit turned 62 after January 1, 2016. The restricted application is not available for a person who turned that age back in January 1, 2016.
Okay, we mentioned divorces also, but the major difference with that is that they have to have been married for 10 years, I believe.
Exactly.
And
And not married before age 60 or 62,
Okay.
one or the other. But again, the divorced person would be entitled to a spousal benefit,
Okay.
providing the big criteria is that they're married at least 10 years and did not remarry before age 62.
okay. Now, under the retirement plan tax, Freeman, is there a different formula for calculating the qualifying quarter of coverage? Or in other words, how does one qualify for Social Security under the new tax law?
Okay. To become eligible for Social Security, you need a minimum 6 quarters of coverage and at least 1 quarter each year after your turn, after the age of 21. But however, after reaching 40 quarters, you can become eligible for the individual retirement benefits, that is your Social Security benefit, with 35 wage-adjusted earning years. So that's key, okay? So there has been a little bit of increase in the last 20 years of the coverage, they call it QC, all right? It's increased over 78% from $740 in 1999 to $1,320 in 2018. All righty. Oh, and again, married and divorced spouses are eligible for spousal benefits as well. Okay, once you qualify for your Social Security.
Okay, very good. Okay, well, can you give us some examples? We're talking about AIM, how much one can expect under the average indexed monthly earnings at ages 62, 66, and 70?
I sure can.
Okay.
Each and every year, Social Security Administration use an algorithm
Okay.
to determine your primary insurance amount, referred to as Social Security benefit. And this is called what you, the bend points. There are 3. It's a very complex formula for using to determine that PIA. You can go to SSA.gov, and if you wanted to, you want to get detailed, it would go through and show you the average index and etc. But believe it or not, Carolyn, this, no matter how this PIA formula is applied, primary insurance amount applied, if you file at age 62, you lose 25 to 30% of your benefit. Full retirement age 66. If you apply at 65, it's 93% of your full retirement benefit. So that's permanent. So what we're going to do here is we're going to take a break. And we will return shortly after these important announcements. Stay with us. We'll be right back.
Minds can achieve anything. We make sure they get to college. Federal student aid provides more than $150 billion in grants, loans, and work-study funds to make college possible for anyone with the mind to get there. Because if given the chance, minds will do great things. Federal Student Aid, proud sponsor of the American Mind. Learn more about money for college at studentaid.gov.
Well, thank you for joining us on Skills to Pay the Bills in today's segment of Just Ask Freeman.com. You know, Carolyn, today we're talking about the jobs and the Tax Act.
Yes.
All right, of 2018, the Tax Reform Act of 2018, and decisions that we all must consider with respect to our retirement. Carolyn, this is important stuff that we have to relay. What are we going to talk about next?
Well, let's talk about the 2018 Social Security changes. I'm just going to list them and then we can go in more detail.
Okay,
You know, there's a Social Security wage tax,
Yep.
where you have the maximum taxable wages, and there's the maximum benefit amount, and then there's the average benefit amounts.
Exactly. And when you look at these maximum taxable wages, let's go back a couple of years. The minimum in 2016 was $118,500. 1 year later, the minimum, or I should say the maximum taxable wage, had increased $8,100 to $127,200. This from 2017 to 2018 currently, the Social Security wage tax is $128,400. $500, okay? But I noticed in 2017, between 16 and 17, it was the highest increase in Social Security wage tax history. We still have to pay 6.2% of our earnings. Now, employees receive a W-2. Self-employees, their cut, or I should say their percentage of earnings received from a 1099, or on the 1099 they get, is 12.4%. All right.
Okay.
Now, full retirement age. There is a new maximum benefit amount at full retirement age for 2018, $27.88 per month. Now, yes. Carolyn, we talked when you gave that shared that bullet average benefit amount. Tell me what our single people and some of the married couples, or what their average is each month.
Okay, the average for all workers is $1,404 a month.
Wow.
Yes, and the average for married couples is $2,340.
Well, you know, a lot of folks have their mortgages or some rent is over $1,000 or $1,200 to $1,400 a month. So the average benefit. But you know what's interesting about that too? I remember when Social Security was a big part of our retirement planning when it came to guaranteed income. Social Security used to supplement our pension, just like my father. He worked at Buckeye Steel for many, many years. My mother was a homemaker. My brother and I lived there. He took care of everything. But when he retired, his pension was supplemented by his Social Security. Okay. All right. Now it's almost the reverse, because Social Security only covers 36% of your retirement income. You could, if you had a pie chart, you could see the 46%, and that piece of the Social Security pie has decreased. So now it seems that we need our own retirement, or I should say our own personal resources to supplement Social Security. Now, Social Security is very, very important. However, it seems that it's reversed based on these average benefit amounts, that we have to supplement our Social Security benefit. All right.
Yes, because pensions have pretty much gone by the wayside.
Exactly. And we're going to talk about that, what happened to pensions. Okay. All righty. Let's talk about some of the potential Social Security changes due to the, notice I said potential Social Security changes.
Yes, we know that they're talking about, or there's a possibility of increased full retirement age for those born after 1960. Wow. Yeah. So I don't have the exact figures, but they are talking about increasing the full retirement age.
You know something too? That increased full retirement age, if you're born after 1960, we have seen the statements that has been generated that the client picked up from the website ssa.gov. And we review and then we produce Social Security reports. Because for the most part, 10,000 folks turn 65 every day. Every day. Now, for the most part, many people don't know, and what we've seen, don't know when to file, how to file, and how to take advantage of some of the strategies that are available today in maximizing your Social Security. Now, when we see that statement, Carolyn, from a person that's born 1960 and beyond, we've seen the full retirement age significant increases, 66 in 4 months, 66 in 7 months, 67. Well, you know, how far will it go? Will you be age 70, 75, getting your, after you work 35 years, 40 years? So there has been, well, I've seen it, increased full retirement age, and there is the potential to increase the full retirement age to be eligible for the full retirement age benefit.
Yes.
Let's talk about decreased cost of living adjustments.
That's another discussion. You know, we've talked about how the COLA has gone down, and they're talking about decreasing it more. I think it's like 2% now.
Yeah, we get 2% January 1 of this year. Well, I remember those years where it was 0-0. Not too long ago, it was only 3.1. Now, suppose I'm getting $1,000 a month, and I got a 2% COLA. How much will I get What would be the amount of my Social Security benefit with a 2% cost of living adjustment for those who are not unfamiliar with COLA?
I believe it's about a $20 big raise.
Exactly. And one of the things we always consider when we are helping clients with their maximizing their Social Security, we take into consideration the fact that even though we got a COLA, and you named it, 1.6, we started 3.75, it kept decreasing. Well, increased cost of healthcare.
That's one of the biggest increases.
Our life expectancy has extended, all right? Skilled care, referred to as long-term care, those are increased costs. I don't think $20 is going to do it. Also, when you look at the fact that energy cost has increased and keeps on increasing. Food prices steadily. You were at the grocery store the other day,
yes.
And for the goods you spent, say $100 for 5 years ago, or let's say last year. All right, you're paying $125 to $150 for the same goods, the same items. That's right. So with the possibility of a decrease of living adjustments, that's critical.
Yes, it is.
One other point I want to make, Carolyn, we were talking about this changes to the PIA. Now, I don't know, I know about a little bit about the algorithms that are used by SSA, and as I told our viewing audience, they can go to ssa.gov, and if they want to know how the primary insurance amount is calculated, they can go through those different points there and calculate it, and it's very, very complex. But there may be a possibility, there is a possibility there'll be changes to that calculation formula for the PIA. Now, we don't know whether or not it's going to go up, or, produce more, or it could be less. I'm looking at less based on the potential. Based on this jobs and what they call it, the Tax Reform Act of 2018. Okay. Now, another point.
The reduced delayed retirement credits.
Exactly.
Yeah.
Now, we just sat here and we talked about briefly the advantages of the file and suspend strategies, the restricted application, and how one, a married couple as well as a divorce filer, can benefit from an 8% increase of their Social Security benefit. Well, that may be reduced. I don't know what the interest rate could be, but these are little things here that you kind of pick out and you say, well, increase full retirement age, decreased cost of living, the calculation of your primary insurance amount, your benefit, reduced delayed retirement, and increased payroll taxes. Now, I know I gave an example, 2016, 17, and 18. I want to back up to something too, Carol.
Okay.
Calculation of that PIA. For high income earners, you stand the risk of paying more, okay, in taxes for your Social Security benefit. If you're earning $250,000 on up, or $300,000, $500,000, for the high income earners, they can expect to pay, it's called, I think it's referred to as IRMA. They pay an additional tax, and I've seen it, $350, $400, upwards to $350, $400 per month, as well as your Medicare Part B premium in there. So if they change the benefit in calculating the PIA, I hate to use that increment right now, the primary insurance amount or the Social Security benefit, you end up paying more if you have a high income. So that's going to be adjusted too, and that coincides with the increased payroll taxes. Yes. Now, there's an important part that I want to make clear. Carolyn, we're not taught how money works.
No, we're not.
Okay, I mean, you can come through high school, college, you have special degrees or certificates. Most Americans are not taught how dollars work. Here's one thing, and I'm going to tie this in. In 1980, 89% of the companies offered a pension.
Yes.
Only 7.5% of total company pension plans were defined pension plans as of last year, because we've been subjected to what we call defined contribution plans. Placed it into we put our money into TSP, or 401k, or 403b, employer-sponsored retirement accounts, and we're not even taught how that works. So income sources are changing. We have to supplement Social Security retirement benefits, retirement savings, qualified money, that's pre-tax dollars, if we're fortunate to have a pension plan. You know what, Carolyn? The clock on the wall says we're about out of time. But I trust, folks, that we have shared some valuable information today, educated you at least on the changes in the Social Security benefits and how we just can't rely mostly on Social Security. We have to use our own resources. So I want to remind you to email me at Freeman@JustAskFreeman, and I will send you a Social Security and tax update. It's a quick reference consumer guide. And I want to thank you for watching Skills to Pay the Bills and today's segment of JustAskFreeman.com. Carol and I will see you sometime next week for another great segment.